Welcome. Today is Thursday, April 18th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Daily Five, of course, is the show where we go through the top five charts that are kind of on our radar screen. Of course, as usual, we're going to break the rules a little bit today. We have two additional bonus charts, so it's going to be your Daily Seven today. But before we get started, I would actually just like to give you a quick heads up. The newsletter that went out on April 6th was a huge success. Actually, it broke all sorts of records for us in terms of monthly views, monthly new paid subscribers, monthly new free subscribers. Apparently, people liked it. So if you're interested in our newsletters, you can find it at hugeinsights.substack.com. For those of you who don't know what I'm talking about, we do publish a monthly investment newsletter. It's available on Substack. It's free to subscribe. It's delivered directly to your email inbox on the first Saturday of every month. That's usually following the NFP report. The newsletter is affectionately titled Huge Insights, the Big Picture. Inside that newsletter, we cover a lot of key macro factors. We engage in a little bit of creative writing in order to make our point stick in your mind a little bit more. But for the most part, we dig deep into the economy and the markets. Oftentimes we get emails from folks that say, hey, we love your top-down view of the world. How do we put this into action? And so we've created kind of a upgrade to paid version of the newsletter for those who want more. It's very inexpensive to upgrade, just about $12.50 a month. And that includes our monthly market forecast, our positioning recommendations, and a lot more. In fact, paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. That is an institutional report that comes with our institutional service normally. We provide that to paid newsletter subscribers, and it actually details our top actionable trade idea each week, and also provides some updated market commentary and sector rotation perspectives. That comes out every Wednesday afternoon. And in addition to that, we also provide some privileged access to periodic interim bulletins and quarterly video content. In fact, for all those who are paid subscribers, by the end of today, we are going to publish a quarterly video that we just did on Monday to one of the technical analysis associations around the world. We do this pretty frequently. And so we'll put that video out just for paid subscribers. So if you're interested in getting kind of our second quarter outlook on the market, that'd be a great way to get everything in kind of one bite-size morsel. With that said, I'll just close by saying that the next publication is scheduled for May 4th. So for those who are waiting for the next issue of Huge Insights, issue number 33 will be published on May 4th. Let's jump into the charts. Chart number one really just reviews year-to-date returns for the key indexes. A couple things that I wanted to point out. Number one, obviously, regional banks here getting destroyed, down some 14.2% year-to-date. Something is wrong in the banking system, and the market smells the problem. We don't know exactly what that is. We hear the bull case every single day in financial media, but there's something wrong here, and it's clearly showing up in the price of the stocks. Small caps down 5.8%. Value stocks down 1.8%. Foreign stocks are flat for the year. Mid-cap stocks up about 1.8%. Growth stocks, the NASDAQ 100 up about almost 4%. The S&P 500 as of yesterday's close was up 5.29%. Interestingly, the S&P has given back half of its year-to-date gain through the end of the first quarter. Most of that gain, of course, came from mega caps. Top 50 stocks in the S&P 500 up about 8% through last night's close. So, we continue to see portfolio managers and investors across every ilk clinging to those top mega cap names, with their kung fu grip. like it means like it contains the antidote, right? So at the end of the day, the mean return for the S&P 500, that's the average stock's return, is under 1%. The median return for the U.S. stock market is negative 3.6%. So this is not a bull market. This is a highly concentrated market where, some big stocks in the indexes are putting up big returns, and the vast majority of stocks are really lagging dramatically behind, and many are negative, certainly more than half based on the median return. Okay, let's jump into chart number 2. We're seeing a volatility breakout, the CBOE VIX index, which is really a measure of implied volatility of at-the-money options. That has surged in April from a recent low of 12.5% at the end of the first quarter to a recent high the other day of 19.5%. Now, in tandem with that 56% spike in the VIX, the CBOE skew index, which is a measure of implied volatility of out-of-the-money options, has absolutely collapsed from its recent high of 157% to a recent low of 135%. By the way, 100% is considered normal for this index. That's the typical smile of skew in the out of the money volatility curve. The way that we would interpret this chart is that at the end of the first quarter, the demand for out of the money call options reached its utter peak, and since that time has plummeted, just as the demand for at the money put options, which was effectively nil at the end of the quarter, has begun to surge. And so, both of these volatility measures have broken key trend lines. And, with the VIX also reclaiming its 21-day moving average, this has been pretty important in the past. Usually you've seen when it reclaims that level, you get a pretty sustained surge. Here we see a sustained surge. There, it's repeating. And so we've seen that breakout above the 21-day, also a push above what was support is now resistance. And so, we've really compelled or propelled the VIX above some key headwinds here. Trend, chart, and moving average resistance have all been broken to the upside. And, at the end of the day, we juxtaposed these two indexes above, the skew above, the VIX below. And in the past, when these indexes have converged, the skew going back down to a very low level, the VIX going to a very high level, it's looked like alligator jaws snapping shut. And so, we've posed the question again, are the alligator jaws poised to snap shut? We think the answer to that is yes. And in fact, we think the VIX will likely push well above its prior highs that we've seen here in the mid to high 30s, and potentially even test the 40% range. And so that's kind of our thinking in terms of volatility in the near term, near being, say, the next couple of months here through the second quarter. We would expect a fairly significant surge in volatility, potentially testing the 40% range. Let's jump to chart number 3. Investor sentiment is clearly rolling over. In the last couple of presentations, I've focused on advisor sentiment, which just hit a boil last time we showed the chart, which was a couple of weeks ago. It is also beginning to roll over, along with some more common measures of or well advertised measures of investor sentiment. And I'd say very consistent with the message that we're getting from the VIX and the skew indexes. The name exposure index, which is a weekly survey of professional investment managers and asset allocators, that saw a contraction from around the 104, 103 levels that we saw a couple weeks back to back, down to around 82% here. And, that actually put in a negative divergence. We saw a 104.3% level, and then a pullback, and then another rally up to 103.4%. And, that negative divergence did not confirm the new all-time high in price. So that is something that's interesting to us. In addition, we also saw the recent results from last week's American Association of Individual Investors. This is the AAII sentiment survey. Again, a weekly survey of individual investors. What we found is that those describing themselves as bullish slipped from about 47% to 43% last week. And those that described themselves as bearish went from 22 to 24%. So a slight uptick there as well. But what that resulted in was a further decline down to around 19.4% in the bull-bear spread. That's bulls minus bears. That sustained a double negative divergence that we've seen dating back to December, where we had two back-to-back readings of 32%, then a pullback, a rally up to a lower high, pullback, rally up to a subsequent lower high, leaving a negative divergence and a second negative divergence. We call it a double negative divergence. Our old friend Tom Fitzpatrick at Citigroup used to talk about double and triple negative divergences quite a bit, and the significance that they would have. And we concur. There's more significance to a double negative divergence. And I think the real interesting thing here is that, while investor sentiment has certainly come off its recent boil, the failure of these sentiment measures to confirm price at the all-time high here on March 28th can oftentimes signal the point of recognition amongst the wisest set of investors out there that the market has gone too far too fast. And recall, we did get an advance in the S&P 500 from its October lows to its March highs of around 27.5% in just 105 days. That was an extremely sharp move to the upside, very unusual. We've called it an unusual ascent, and that will probably be followed by an unusual correction as well. So let's jump into chart number 4 here. Chart number 4 details the Dow theory approach to market analysis. What we've observed here, as you can see with the Dow Jones Industrial Average pointing to a new all-time high in March, the transportation average in the lower panel failed to confirm that high, leaving a negative divergence in place here, both at shorter term and longer term, but actually dating all the way back to October of 2021, where we saw both the transportations and the Dow make their highs. And then the Dow made a slight higher high in January, I believe January 5th. But, the point being that, this high has never been challenged by price since October 2021. Prices got close and they pulled back sharply. They failed to challenge it again. And even though the Dow Industrials broke out, we see that non-confirmation. Now, I don't want to go into a big lecture on Dow theory, but for those who are completely unfamiliar to what we're talking about, Dow theory is basically an approach to market analysis that was developed by Charles H. Dow. Charles Dow was the founder of Dow Jones Company and also the Dow Jones Industrial Average back in 1896. He believed that the stock market as a whole was a pretty reliable measure of overall business conditions in the economy, and that by analyzing the overall market, you could accurately gauge those conditions and identify the future direction for stock prices. And so, for a trend to be established, Charles Dow postulated that the indices or the market averages must confirm one another. And that simply means that, the signals that occur in the index of stocks that produce the goods must also correspond with the signals that occur in the index of stocks that transport the goods. And if they didn't, then the market might be sending a false signal. So in short, the Dow Jones Industrial Average, if it climbs to make a new high, then the Dow Jones Transportation Average must also climb to make a new high in order to confirm that uptrend. And that is not the case today. Therefore, we have a Dow Jones Dow theory non-confirmation. Okay, that's a bearish signal, by the way. Chart number 5, and then we'll jump into the real meat of the presentation, which is the bonus charts that we have. Chart number 5 really digs into the S&P internals, and they have utterly collapsed. Now, we look at the internals on a weekly closing basis, but we did update the charts through yesterday. But last week, we saw S&P 500 market breadth utterly collapse to 83.4% of issues were negative last week on balance. And moreover, the 5-week moving average of the percentage of net advancing issues in the S&P 500 has also turned sharply negative. It's negative 12.2% right now. That's this blue line right here. And as you can see, we had a double negative divergence illustrated here before this collapse. So it was giving a bearish indication for a number of weeks, months actually, and kept us waiting at the altar basically. But as we've been talking about for some time, these signals should not be ignored. And what we're seeing right now in recent market action, month to date, anyways, is that those signals were confirming a downturn in S&P stock prices. And so, and in fact, broad stock prices as well. But let's look at momentum again here. This is the 5-week momentum measure that we use. We typically use PPO to measure momentum. This is a percentage price oscillator. It's measuring the deviation of prices from a moving average. In this case, we're using the 5-week exponential moving average. We also look at the 10-week exponential moving average pretty frequently, but the 5-week from a short to intermediate term perspective gives us a pretty good indication of what's happening. And sure enough, we had a pretty identifiable or observable negative divergence in momentum right before the collapse. And so what we've seen is, since March 28th, we got a failure of momentum to confirm the new high in price, and subsequently this negative divergence has resulted in a collapse in momentum as well as stock prices. And typically these negative divergences tend to be a precursor to a major trend change. It tends to be a bearish condition. Okay, net advancing volume in the bottom panel here. We saw 5-week. Well, first of all, we saw last week's total S&P 500 volume. 9% of total volume was on the upside. That means that 91% was on the downside last week. That is not bull market condition. And in fact, if we look at the 5-week moving average of the ratio of up-down volume, it actually ticked down slightly last week to 1.17 times from 1.32 times, but it's kind of been flat, as you can see, in this kind of, 1.5 to 1 kind of range. And we do have a negative divergence here as well. And, generally for a bull market to exist, you need a reading of around 4 to 5 times. That would be consistent with, a pretty steady bull market. Something in the kind of 1-to-1 ratio is not really going to push stocks higher. Okay, let's jump into the bonus chart. Bonus chart is really looking at the S&P 500. This is a daily range chart looking back about 8 months for the S&P 500. In the lower panel, we're using a 10-period PPO momentum oscillator. And the first thing I'll point out is that you can see that there was a pretty steady range here for momentum, right? It was kind of captured by this box, and the whole time that we're in that range, the market was advancing. Well, something changed here. The character of that momentum has changed, and we believe the character of price is going to change as well. So what do we have right now? Well, first of all, the S&P 500 has breached several key trend lines. We put a couple of them in place, but you could draw, half a dozen trend lines that have been broken by the S&P. What we prefer to do is create a parallel trend channel off of 1, 2, 3, 4, 5, 6 different highs. So we think these touch points are pretty meaningful. We would also point out that this center or median line, if you will, also connects with closing lows, an intraday low, and a closing low. This is the precise center of this trend channel. And then off of this closing low, just projecting up. We can see that yesterday's close was through the bottom of that trend channel, and so it also penetrated the upper boundary of gap support. And so, between this, what we're looking at here is that a market that's in trouble, that's breaking trend lines, that is, struggling to hold above key support levels, both trend and chart support levels. We have seen a market that's broken below its 10-day exponential moving average here in blue. We saw the initial break here on a closing basis, a rally back, a fail, and it continues to roll over. We saw a clear break of the 50-day simple moving average, and we're right now looking at a potential dead cross between the 10-day and the 50-day, which is generally a bearish condition. Okay, when shorter term or faster moving averages cross below slower moving averages, that's an indication that price is gaining momentum on the downside. And that's precisely what we suspect is likely to occur here, as evidenced by the arrow that we're illustrating. So what happened in this little range from here to here is we saw a negative divergence develop on the 10-period momentum oscillator that we're using, which was a pretty good indication that this was a top on March 28th. It also happened to occur right in the midst of a 2-week Montgomery cycle turn window. This was a major turn window that included a solar eclipse, and it wasn't just any solar eclipse. It was the solar eclipse that occurred on April 8th, and that was the last visible solar eclipse in the United States of America for the next 20 years. So we won't see another one from the lower 48, if you will, until the year 2044. So a pretty important turn window here, I think, from a cycle perspective. And in our opinion, it probably suggests that our Elliott count is correct. And what we're illustrating here today is just, our preferred Elliott wave count at minor degree of trend. Minor degree is like these parentheses, 1, 2, 3, 4, 5. That's the uptrend off the October 27th to March 28th period, roughly 5 months. And we've also indicated some of the subwaves here. So we're counting at minute degree of trend, an impulse wave here, 1, 2, 3, 4, 5 to complete minor wave 1. This was the extension. Oftentimes the extension comes only in wave 3. Sometimes it'll be wave 3 and wave 5. Unusual for wave 1 to be the extension, but sometimes in a blow off top, you see the initial surge shows up in wave 1 as opposed to wave 5, which appears to be truncated based on our work right now. In the midst of wave 2 and wave 3, we've counted at sub-minute degree or minuet degree, an impulse wave 1, 2, 3, 4, 5 to complete minute wave 1, which was also an extension. So oftentimes you get these fractal relationships where minute wave 1 in minor wave 3 did the exact same thing that minor wave 1 did. It subdivided and extended. Okay, so we'll pull back here to minute wave 2. We could see 1, 2, 3, 4, 5, minute wave 3, a pull back to wave 4, wave 5 of 3 to complete minor wave 3. Then we have a symmetrical triangle, which is very commonly in the fourth wave position. We believe this is minor wave 4. And so if we're correct about that, then this next 5 wave push up, 1, 2, 3, 4, 5 was the end of minor wave 5. And if our larger degree work is correct, and we're not illustrating it in this chart, but this would be minor wave 5 of intermediate wave 5, of primary wave 5, of cycle wave 5 to complete super cycle wave 3. So if we're right about the big picture, we just terminated a 92-year super cycle advance on March 28th. And if that is correct, then the decline that we're seeing so far off of that high really just represents the initial subdivisions of intermediate wave 1 down, of primary wave A down, of cycle wave A down, of super cycle wave 4 down, which promises to be an epic decline that could extend over more than a decade, in my opinion, possibly as many as 13 years. And I think it could carry the S&P 500 down to levels that we haven't seen for, the last 15 years. So with that said, I think we've seen minor wave one and minor wave two, which were rather small. And then minor wave three is subdividing at minute degree 1, 2, 3. We expect a fourth wave rally to probably move us back up into this area right here, and then a breakdown in what will likely be minute wave 5 to complete minor wave 3, and we think that minor wave 3 will then be followed by minor wave 4, which would probably come back up and kind of test this support, which will now be resistance, and then ultimately carry all the way down here into a range that we think is most likely going to correspond with this 200-day moving average, which comes in around, say, 46.68 or so, and also this 50% retracement level. That's around 46.84, I believe, if I can read that properly. So that's kind of where we're looking for intermediate wave one down to find support. Now, intermediate wave one will be followed by intermediate wave two. Second waves can retrace up to 100% of first waves. So we don't really know what to expect just yet. But, once we see how the pattern develops and terminates, will give us a better sense of how to gauge wave two. And we'll review that at some point in the future. Okay, let's look at bonus chart number 2. This is the final chart today, and we want to leave you on a high note. What can you do if you're an investor and you're looking at this analysis? And by our work, we believe that we're in a pretty pretty critical juncture within U.S. equities and global equities, for that matter. And we think that the major move to the upside is complete, and we are now beginning a major move to the downside. So we want to, kind of pivot away from equities and move into other asset classes that we think have potential to move to the upside. And one of those contra assets is precious metals. And we talked about gold in our last video, which was about 2 weeks ago. I wanted to talk about silver, which is a recent development. We actually recommended this on the 10th of April to our paid subscribers. And, it's moved up kind of nicely since that breakout. But what we're seeing here is a breakout at a monthly degree level of this very small degree. I would call it a classic pattern-based formation of the inverted head and shoulders variety. You've got your left shoulder here, your head, and then your right shoulder there, and a breakout above, a descending trend line off of this 2011 high back here. But this takes out that trend line, I think, definitively. And we've taken out these closing prices here back in 2021. And so we're pretty confident that breakout above 28, if it's sustained, will probably carry us back up to around 38 or so, which are these highs here on a quarterly closing basis. Now, if this small degree pattern turns out to be part of a larger degree pattern, we think it is. We think this is a larger degree pattern. We think the entirety here looks like a 40-year classic pattern-based formation of the cup and handle variety. We actually illustrated it as a cup, just for your benefit. But if in fact that pattern recognition is correct, well, looking at the very long-term chart of this continuous contract of silver bullion, we can project a measured move upon a sustained bullish inflection above this 38 level here that would carry the price of silver up to approximately $62 an ounce. And so, that would be our longer term stretch target for silver. But, with the action in the gold and the, historic tendency of silver to chase gold, to chase and surpass it, we think silver could actually be the better performer in terms of returns over the same period of time. So for the remainder of the year and for the years ahead, we think precious metals make a lot of sense for investors. And we like silver as a nice catch-up trade with some significant upside potential over the course of the next year. We have some additional price targets using Arthur Scleroux's rule of 7, but I don't want to go out with those numbers today. They seem pretty far-fetched. Maybe I'll just throw out one. We think $100 an ounce is achievable. That's a rule of 7. That's our initial rule of 7 extension target. But they get pretty aggressive beyond that. And so if we do see the sort of moves that we're expecting out of gold, I think that these more extended moves in silver are likely to be achieved as well. So with that, we'll end it there. If you'd like to follow up with us, certainly you can contact us by going to our website, www.jwhinvestment.com. If you want other free content, occasionally we'll put out some insights on Twitter, now known as X. You can find us there under the handle @alpha_insights. And of course, if you're interested in our newsletter, the best way to access that is to go directly to Substack, hugeinsights.substack.com. Again, it's free to subscribe. Comes out the first Saturday of each month. So give it a look. It's probably worth your time. With that said, I want to thank you very much for watching and wish you the best of luck trading.